There's no denying that life is getting more expensive. The cost of everything around us is on the rise, and so is taxation. In this video, I'm going to be showing you 5 legal tax strategies in order to reduce the amount of tax that you pay for a UK director. Let's get into it. Strategy 1. Alphabet shares. These are different classes of shares within your limited company, otherwise known as A shares, B shares, or C shares, that allow you to pay different levels of dividends to different individuals in your company, even if they don't own equal percentages. They also allow you to add what's called particulars, which essentially rules to the shares. So one of these rules could be that that individual has rights to dividends, however they don't have rights to a share in the company should it wish to sell. It also may have another rule that says it is conditional. So the main shareholder in the business could remove that alphabet share at any time, giving a great deal of flexibility on this share class. In practice, this allows you to incentivize key employees via dividends rather than just salary, bonus, etc., which gives you greater flexibility in remunerating individuals in the company at a more tax efficient rate, providing all of the commercial checkboxes are ticked. Another practical way of using alphabet shares is by allocating a level of income to spouses or family members within the company, providing again you're ticking all the commercial checkboxes. And this allows you as a UK director to allocate salary and dividends under lower tax rate bands to save you tax, while also having the commercial benefit of being able to incentivize key employees, which is going to reduce your employer's national insurance bill. A few notes on this: HMRC can challenge this as tax avoidance if they don't see the commercial benefit to the business for doing this. So make sure you engage an accountant, a tax advisor, and potentially even a corporate solicitor to amend what's called the Articles of Associations on Companies House, and also make sure you compliance plan around this before implementing this strategy. A bonus tip for you: when implementing this change, submit the form SH02 to Companies House. Also do board minutes, and I also advise you do dividend vouchers to make sure you keep accurate records of all dividends distributed to any shareholders, no matter what the class is. And the next strategy is by paying yourself efficiently, by using a director's salary and then dividends up to the most efficient rate for you and your specific situation. You can also use a spouse's basic rate band to maximize household income and minimize taxes payable. This is essentially a mixture of employment income, which you can set up with your accountant, usually to 12,570 per annum, and then dividends, which is taxed at 8.75% up to a total earnings of £50,270. You can then repeat this times 2 if you also have a spouse that's involved in the business, taking household income up for 2 partners up to £100,540 while paying a low rate of tax personally. It's worth noting that you do still pay corporation tax inside the limited company on this, and you need to make sure you do the right planning with the right advisor. Some bonus tips for this one: make sure that you time the voting of your dividends correctly. Simply put, when you declare the income, make sure it's the right time to maximize tax efficiency. Don't just do it based off payment date, because you can leverage your director's loan to place it in the right tax years to pay the lowest rate possible. You also need to make sure that you have sufficient retained earnings before voting a dividend, so make sure you speak to your advisor on this one to tick all the compliance boxes. The next strategy is making sure that all the small benefits, allowances, and expenses that you wouldn't usually claim in the business without being told you can do are claimed the right way. And these are the smaller things that you'll see on my social media, such as trivial benefits, 6 Amazon vouchers per year at £50 each. Check the video for full details. Relevant life policy: you can get an insurance providing it's the right policy in the business and claim tax relief. Private medical insurance: it will be a taxable benefit, but it's still deductible by the company. You can claim mileage, 45 pence per mile, for the wear and tear of your personal vehicle. All these things stack and add up and create larger tax savings for you and your business. Make sure that you're looking at the checklist that is applicable to your specific scenario, and you're ticking all these off one by one to reduce your overall tax bill as much as you can in the company. One bonus tip for you on this is if there's any expenses that you incur personally, and what I mean by that is, let's say you don't have a phone through the business, but you use a phone that you purchased personally, or you work from home and you want to claim an allowance for working from home, or you have broadband that you pay and you use an element of that for the business. You can do what's called a partial claim and introduce it via your director's loan account, meaning you can take that funds back out personally, tax-free, and you can also claim corporation tax relief in the company. So it's worth doing a checklist and always checking your personal bank statements to see, have you spent anything on behalf of the business, or is there anything personally that you pay for that the business business has benefited from that you can introduce the value for, claim the expense, and pull it back out tax-free for you. The next one is a director's pension contribution. Well known that you can claim corporation tax relief on this, but I'm going to give you an additional tip. You can claim up to £60,000 per year in your director's pension that's fully tax deductible in the limited company. Assuming a corporation tax rate of 25%, that's a £15,000 saving for each director. However, it's worth noting that you can use what's called carried forward allowance, providing you tick the right criteria boxes and essentially bring forward previously unused allowances to increase the amount that you can put in your director's pension, therefore increasing the amount of corporation tax relief that you get in the business. For those of you that are interested in commercial property, you can actually invest in what's called a SAS, a small self-administered scheme that is available for you to use for the purchase of commercial property. And in that scheme, you can get a mortgage. So let's say you've invested over a period of 10 years, £200,000 into that pension pot. You could get a mortgage for a further £100,000, taking your total capital value with any appreciation that you've had through that time up to £300,000. You could then go and purchase a commercial property that's owned via the pension scheme. You could rent that commercial property back to your limited company, claim corporation tax relief in your limited company for use of the premises, pay that back to your own pension pot where no tax is payable, and that balance can accumulate. This is a top tip that not many people use or know about, and is definitely worthwhile considering as part of your overall strategy. It's worth noting that this property needs to be genuinely commercial, not residential, and if you want to actually implement this, ask your accountant or advisor to refer you to a pension trustee or a SAS provider. The final strategy is your director's loan account, strategically using it to its maximum capability, which not a lot of directors do, so listen close. You can borrow up to £10,000 from your company without triggering any income tax or national insurance, which can satisfy a short-term cash requirement personally and avoid taking you into higher rate taxes. You can actually borrow more than this, providing you charge HMRC's official rate of interest. It's worth noting that the amount that you owe back to your company, which is essentially an overdrawn director's loan account, needs to be repaid within 9 months and 1 day of the company year end, or you'll have to pay what's called S455 tax, which is temporary taxation, which, trust me, you don't want to pay. The next one, which I touched on earlier in the video, is strategic use of timing your dividends. When you take money out of a company, you can choose to take it via your director's loan account or take it via a dividend. Now, if you temporarily allocate it to director's loan and then later down the line declare it as a dividend to clear down your director's loan, this allows you to strategically plan when you declare your dividends, therefore reducing your personal tax liability with the right planning. The next is claiming tax-free reimbursement for out-of-pocket expenses that you incur personally, also referred to earlier in the video. So you use your personal card by accident for a company expense, your director's loan account is how you then allocate that back to the business to repay the amount via a reimbursement and also claim tax relief. And the final one worth noting here is reclaiming capital that you've invested or lent to the company back out tax-free. You can also take that a step further and charge a commercial rate of interest, providing you complete the CT61 form, which I've got another video breaking down in detail. And on the interest that you charge, you can claim corporation tax relief in the company and potentially even use your personal savings allowance and your starting rate for savings, which totals £6,000, to take tax-free income personally, reducing your personal tax liability and also claiming corporation tax on the interest that you actually charge to yourself. Here is 5 strategies out of hundreds that I implement with my clients day in, day out. I hope you found it useful. Stay tuned for the next.